Hi, in today's class we are going to see about payment of dividends. Okay, this is relevant both for inter as well as final. Inter it's coming in auditing, in final it's coming in corporate law. Yeah. Now this section 123 of Companies Act 2013. This talks about dividend payments. There are two types of dividends: interim dividend as well as final dividend. In previous act, the interim dividend is not specifically defined in the act, but even though in practical scenario as well as in SS3, that is Secretarial Standards 3, they have talked about interim dividend. Now this Companies Act itself talks about interim dividend. Now we are having two areas which can be used for interim dividends. For example, current year P&L, current year profits. If we are not having any current year profits, then we can go for accumulated surplus in P&L. Then in final dividend, we have three options: current year profits, accumulated surplus in P&L, then reserves. Now, interim dividend can be declared only when there is current year profit. But in case when the current year there is no profit, for example, we have to draw a balance sheet or a P&L account up to the quarter in which we are going to declare a dividend. And in that quarter, if we have profit, one option. And that quarter, if we don't have profits, that is, if we having inadequate profit or loss, then we can go for utilization of accumulated surplus in P&L. What is this accumulated surplus? How it's different from reserves? Now, reserves is the reserves which is transferred from the accumulated surplus and it's parked as reserves. Accumulated surplus in P&L or the surplus which is not transferred to reserves. That means every year you are earning some P&L, means every year you are earning profits, and which is accumulated in the profit and loss account itself. It's not transferred to reserves. So this is called accumulated surplus in P&L. Now, after providing for depreciation of the current year, or if you have not provided for depreciation in the earlier years, after setting off all the depreciation, you can use the profit of accumulated surplus in P&L. Okay, or you can use the profit of current year P&L. If you are having profit, it's well and good. So this scenario is very good scenario. And if you are not having the profit, but you are going for interim dividend, then you can see for accumulated surplus. Okay. Now, if you are going to declare from accumulated surplus, only one rule is applicable for you. That is the rate of dividend rule. Okay. Once you are going to declare an interim dividend from accumulated surplus, the rate of dividend, okay, which can be declared should not exceed the average past 3 years rate. For example, if you don't declare any dividend in past 3 years, you need not go by this rule. That means you can issue any percentage of dividend in current year. So this rule is not applicable. Sir, last 2 years I have not declared dividend, but the first year means third year, before third year means, for example, 2011, 12, 13, and we are thinking of 2014's declaration of dividend, and 2011, 12, 13. 2011 we have declared dividend at, for example, 15%, and 12 and 13 we have not declared dividend of any percentage. Now, can we declare dividend in current year? Yes, it's possible, and the percentage will be 15% maximum. Okay, it's not like 15 by 3, it's 15% individually you have to see. Okay, so the maximum rate of dividend will be average of past 3 years. Then, coming to final dividend. If you are having current year profit and you are declaring dividend, nothing like that. So you can do. Then, accumulated surplus. Accumulated surplus means the same which is discussed in the interim dividend. Okay, if you have accumulated surplus in profit and loss account which is not transferred to reserves, and no rule is applicable here also. Okay, and no rule is applicable here, or no rules. But in reserves there are 3 rules applicable. Okay, rate rule, that is maximum rate of dividend at which we can declare in current year. Once you are declaring dividend from the current year, maximum rate of dividend should be maximum of average past 3 years rate of dividend. If we have declared the rate of dividend, say 10% in last year, okay, 15% in before year, and 10% in the previous year, means 10 plus 15 plus 10 divided by 3. So this is the maximum rate of dividend which can be declared. Then, usage rule. First, whatever amount you have taken out from the reserves, for example, maximum withdrawal is allowed is 1/10 of paid up capital and free reserves. This is the maximum amount that can be withdrawn from the reserves rule. Okay, so first you have to use this for setting off the losses. If you have unabsorbed business loss or the depreciation loss, you have to first set off the losses here. Then what is the balance to be kept from the reserves? After taking out the 1/10 of your 1/10 of your paid up capital and free reserves for declaration of dividend, the balance reserve should be 15% of paid up capital. That means, for example, if you are declaring 10% dividend and there is a paid up capital of 100 and free reserves of 50, that means 150. Okay, we are taking 10%. Okay, so 150 into 10% that we can take from for the withdrawal rule. So we can take up to say 15. Okay, so this 15 we can use for declaration of dividend, and the balance, for example, this is our reserves, and this reserves, this is the balance is 35. So the balance is still maintained at 35%. Okay, so the maximum that can be taken off is the balance should be at least 15%. So the maximum which can be withdrawn from the reserves will be, say here, 35. So you can maximum go up to 35. Okay, that's the concept of this rule. Then, sir, once I am going to declare a dividend, whether I have to transfer any percentage to the reserves, the previous act requires a slab limit. For example, 10 to 12.5, 2.5, 12.5 to 15.5. So there is a slab limit, but in the current act there is no slab limit applies. Okay, it's the act uses the word the board may transfer certain percentage of profits to reserves on declaration of dividend. So it's whatever the board thinks it's appropriate. Okay, whether it is minimum or maximum, it's the board's wish. So this is about declaration of dividend under section 123. Now we are going to discuss about how to declare dividend and how to pay the dividends. Once the dividend are proposed by the directors, they will be declared at AGM. So in AGM, they cannot either increase or decrease because, okay, as per the institute, they uses the word they cannot modify the dividends. Okay, but as per the regulations of table F of schedule 1, it says in AGM the shareholders cannot increase the rate of dividend, but it doesn't talks about decrease the rate of dividend. But as per the institute wordings, it uses the word modification. So once the directors proposes the dividend, okay, in AGM they cannot either reduce or increase, they cannot just modify the rate of dividend. That's what the institute says. Now, once the dividend are declared, for example, in interim dividend, the proposal as well as declaration will be done by directors. In final dividend, the proposal will be done by directors and declaration will be done at AGM. Now, once the dividend is declared, it has to get deposited within 5 days in a scheduled bank account. So there is a separate escrow account should be opened for payment of dividend, and escrow account means the account which is specifically used for payment of dividend, and this will be automatically get closed or transferred to separate account after certain days. Okay, so within 5 days the dividend has to be get deposited into a separate current account, and the directors shall take all the steps and all necessary steps to be taken to post the dividend warrants, okay, and payment of dividend within 30 days, and this 5 days is included in this 30 days. So we have maximum cutoff of 30 days and the 5 days is included in the 30 days. So we have to pay the dividends. Now once the dividend is declared and deposited, then within 30 days it has to be paid off. If we have surplus there, for example unpaid or unclaimed dividends, okay, shareholders didn't claim any dividends, okay, if we have any surplus, then it has to get transferred to unpaid dividend account. This is also a separate escrow account. The escrow account titled as unpaid dividend accounts. Okay, this is to be transferred within 7 days or from the 30 days. So 30 from there, next 7 days it has to be transferred to unpaid dividend accounts. Once, if you are not transferring this to unpaid dividend accounts within 7 days, 12% interest will be charged on the total amount, total unpaid amount or unclaimed amount. Now this will be stayed here, this will be kept here as unpaid dividend accounts up to the period of 7 years. After the expiry of 7 years, okay, it will go to Investor Education Protection Fund. Sir, within the 7 years, can the shareholder claim the dividend? Yes, they have an option of claiming the dividends. Once they prove that they are the original shareholders and they come out with the share certificate, they have a right to get the dividend here. Now, if there is a violation of this provision, say example, after declaration the directors are not paying the dividends. Now the directors are as per the act, they can be imprisoned for up to the period of 2 years, and they can be even fined for not less than 1000 rupees per day, and the company will be fined up to 18% of declared dividend. Now, sir, there is an exception to this fine and penalty. Okay, in case because of operation of any law, okay, if they are not paying the dividend, or in case there is certain direction given by the shareholders to the directors to the company that the payment can be kept in abeyance, or then if they are lawfully adjusted with the dues from the shareholders, the dividends are lawfully adjusted between the dues of the shareholders, or in case of any other reason which is not violated the Companies Act. Done.